Okay, hi everyone. This is going to be the second lecture for chapter 5. Get this guy out of the road here. So we're picking things up, looking at the different types of income and the different types of exclusions. So starting with income, right? What you would normally think with this is, hey, your salary, your job, your wages, what you do at your work, right? They pay you. Normally this is going to be classified as earned income, right? Because you're earning it, you're working at your job. This is in distinction to unearned income, more like passive income. For example, things like sales of property, capital gains, dividends, interest, rent, royalties. So if we look here at some examples, all right, let me pull this over, 5.8. This says, hey, we have a taxpayer. They own a stock that has a DRIP mechanism, so a dividend reinvestment plan. Essentially what happens here is normally with a stock, if they pay a dividend, they push out cash. In distinction with a DRIP mechanism, they're going to push out more stock. So the idea with this is, hey, if you own a stock and they give you cash as a dividend, that's taxable income. If in distinction, they give you more stock as a dividend, that's taxable income. 5.9 here, we have a taxpayer. They purchase a CD, which is a certificate of deposit at a bank, right? It credits the account, the interest from the CD, $47.50. Hey, that's going to be taxable income. And a CD, that's essentially a lending agreement. I'll give you 10 grand. You kind of restrict the funds, Mr. Banker, and then you'll pay me interest on those funds. Likewise, right, we have a separate taxpayer. They just look like they accrue some interest in their account from the bank. That's going to be taxable income. So the next item here, 5.10, it's going to, this is just saying, hey, you have rental income. That's going to be on Schedule E, and it will be for the net amount. All right, next item here, annuities. So what's an annuity? Well, this is essentially a steady stream of payments for the same amount under kind of the same terms and conditions. Hey, here's $100 a month, $100 a month, $100 a month. It could be things like an allowance, right, or a car payment, right? Every month you got to pay $400 on your car. The idea with this, from like tax perspective, is that an annuity, we're kind of talking about a financial or retirement annuity. So as an example, right, hey, I have $1 million in my bank account. I'm going to invest that in an annuity, and they'll pay me $150,000 for the next 10 years, right? So I give them $1 million. The next 10 years, they give me $150,000. So in total, $1.5 million. 10 years times $150,000. So in this framework, right, you put $1 million in, you get 1.5 out, you just made 500,000. So with that setup, right, the IRS, says, hey, you don't wait until the end of the annuity to claim the $500,000 you made. Instead, each time you receive a payment, part of that is going to represent that gain, and part of it is going to represent a return of capital. So that's the idea here, and why we use this thing called the exclusion ratio. The exclusion ratio says, hey, we know you put $1 million in and you made 1.5 and you made 500,000. We don't wait until the end to recognize it. Each time we get a payment, we have to recognize part of it. And that's what the exclusion ratio is. It essentially says every time you get a payment, how much do you exclude from income from that payment? Accordingly, what is remaining after you exclude that amount is included in income. It's a little bit wordy there. Let's look at an example to help show us what's going on. Right, so we have a taxpayer. They purchased an annuity. It's going to pay them 10 grand a year for 15 years. So it's a fixed annuity for a fixed finite period of time. She's going to receive the first payment this year, and it looks like they paid 99 grand for this thing. So what's going on? They pay 99. Over the term of the annuity, they get $150,000, right? 10 times 15. The question here is how much of the income, the payment, that is to say in year one, is going to be income, right? So we got to use that exclusion ratio where it's essentially our cost, what we paid for it, $99,000, over our expected value. In other words, over the life of this annuity, how much are we going to get out of it, right? So 15 years, $10,000, $150,000. That's 66%. We get a $10,000 payment in year one. 66% is excluded from income. Accordingly, if there's a $10,000 payment, $6,600 is excluded, then $3,400 is included in income. So make sure you're aware that, hey, the exclusion ratio tells us what is excluded. Whatever is left over is included. That's the idea with a fixed annuity. You also can have a life annuity, right? Like a lifetime annuity. And the idea with this is it's the same ratio, right? You put cost over expected value, but with a lifetime annuity, the expected value, it's a little bit unknown, right? Grandma, if she's buying this retirement plan, she could live 5 more years, she could live 20 more years, right? It's kind of a question mark. So when we're figuring out how much this thing is worth, the IRS gives us a little table, right? So, hey, you got to look, what was the age when the annuity was starting, right, of the taxpayer? Hey, grandma's 70. This gives you a multiple. You do a little bit of math there. Can zoom in, right? It shows us, without the little visual issue there. But that will give you, right, you run the math on it, the expected value. All right, next thing here, property dispositions. So whenever you sell something, right, you don't pay tax on the sales price, you pay tax on the gain, right? So say that we sell something for $1,000, right? Our basis in it was $750, right? For right now, just think your adjusted basis is what you paid for it. We'll build upon that, but generally this is what you paid for it. Accordingly, you're going to have a gain for $250. So you pay tax on the gain, not the sales price, right? They give you a return of capital that's not taxable. All right, next thing here, be aware that income from flow-through entities is going to be taxable at the individual level. So the idea with this is like, hey, we have a partnership and we have 4 partners, right? Let's just say, to keep it simple, each of them would be a 25% owner. This partnership, right, it has 100 grand of, we'll just say, ordinary business income. That's going to flow through, right? The partnership doesn't pay any tax at the entity level, right? Because it's a flow through. Instead, it goes through and each shareholder is going to report their portion of it. So 25 to this guy, 25 to that guy. You get a car, you get a car. And the idea with this is you're going to see this on something called a K1. It's kind of like a W-2 document. So we'll build upon this, right? Just be aware that, hey, if you have income from a flow-through entity, that's taxable. So this is showing you, right, a partnership return. We said, hey, they're going to pay $0 of tax. They're then going to push out this K1, which shows, your percentage of that income. All right, next thing here, alimony. So what is alimony? Kind of like from a legal definition, essentially it is a payment to a spouse post-divorce that helps that individual continue the lifestyle that they developed and maintained during the marriage. So it's kind of like procedurally, what is it? Or trying to help somebody not fall on their feet when we get a divorce. Now, from a tax perspective, the definition is the transfer of cash under a written divorce decree. It can't be something other than alimony, so don't try to sneak like child support or a property distribution in here. When the taxpayers don't live together, that ends upon the death of the recipient. So the idea with this is alimony taxable? right? So it used to be, and what you have to look here is when did the divorce happen, right? When did the divorce decree happen? If it happened, right, before 2019, so, right, if it was like 2018 or beforehand, the idea with this is the payer, right, they're going to get a smiley face, right? The idea with this is I get a deduction for it. I don't have to claim this as income. The payee, right, the person who receives it, is going to have to pay tax on it. So I don't know. Let's just say here, Brad Pitt, right? They got divorced before 2019. He has to pay Angelina Jolie alimony. So he gets a deduction for that. Angelina Jolie has to claim it as taxable income. So she pays the tax on it. If it happened, right, 2019 and after, right? So like under current law, then the idea with this is the payor, right, is not going to get a deduction, and the payee, the person receiving the alimony, doesn't have to pay tax on it. So let's just say we have Liam Hemsworth here and Miley Cyrus, right? Maybe he has to pay her alimony. Here, Liam, right, he's not going to get any deduction for it, and Miley Cyrus is not going to have to pay any tax on it. So that's the idea with it. A couple things here, right? Child support, that's never going to be taxable income to the person receiving it, and there's never going to be a deduction for it. So under current law, right, if you were to get a divorce today, the person who's getting the money, whether it's the ex-husband, the ex-wife, it goes both ways. If if you get divorced today, if you receive alimony, you don't got to pay tax on it. If you receive child support, you don't have to pay tax on it. If you pay alimony, if you pay child support, you don't get any deduction. All right, next thing, winnings, right? So, hey, you go to the casino, you win some money. That's going to be taxable income. You go on The Price is Right, you win a new car. That's going to be taxable income, right? You win essentially whatever the fair market value of what you receive, that's what you have to claim as income. So the problem, right, you go on The Price is Right, you win a $30,000 car, they're going to give you a 1099 for $30,000. All you have is a car, right? You don't have the cash to pay the tax on it. But then the question becomes, right, so say that I went to the casino and I won some money, but I also lost some money. Can I use those losses to offset my income? So say that you won, get the pen here. Say you won 1,000, but you lost 200, right? Can you use those losses? So what would be wrong, right, is if you just net them, right? Like somebody might say, well, can I just put $800 as income? That would be wrong, right? You always, what you do is you have to report them separately, right? So your income, right, that's going to be reported on like line item 1, like upfront on the tax return as part of your income. And then your losses here, you can take them, right? And there's a couple caveats here. So first off, you only get them if you itemize, right? They're an itemized deduction. So what does that mean? Oh, hey, 99% of people who take the standard deduction, you don't get to take them, right? If you take the standard deduction, you don't itemize. So yes, you can take your losses, but only if you itemize. And most people don't itemize. Likewise, if you do itemize, right, your deductions are limited to your income. So in this case, right, you'd be able to get all of them, right? 200 is way less than 1,000. If we change the facts a little bit, right, say you had 500 of income and 700 of losses, right? First thing, you got to itemize, right? If you take the standard deduction, sorry. I do itemize, that's great. However, you don't get all of these, right? What would be wrong here is if you say, oh, I'm at $200 loss. That's great. No, the idea is you get it up to your winnings. So it basically can take you down to zero, but not any further. All right, Social Security benefits, you can look at that. Do not, memorize these tables and stuff for it. Just be aware that, hey, if you're a really low income taxpayer, all your income is Social Security, you're getting $1,000 a month. Generally, that's not going to be taxable. At most, Social Security is 85% taxable. So say that you made $100,000 a year and you still got your Social Security, $1,000 a month. At that point, right, 85% of it, $850 of that $1,000 payment is going to be taxable. So it's not fully taxable. At most, it's 85% taxable. All right, imputed interest and cancellation of debt income. I'm just going to kind of run through these high level. You can look at the example. Imputed income is when we're going to basically constructively say there's income when the kind of nature or setup of the transaction looks like there's no income. So the first one here is a bargain purchase, right? If you work at a car dealership, right? So here's you. And you're like, hey, I want more pay, right? I need to get paid higher. And they're just like, sorry, we can't do that. What we can do instead, right? We have this car that we normally sell for $40,000. Hey, we'll sell it to you for $15,000, right? We'll give you a bargain purchase. The idea with that, the difference, right? So what that would be, $25,000. That's going to be income to you. So there is this little kind of minor 20% exclusion. Don't worry about that. I'm just kind of getting the point across to you. The next one, right, a below market loan. So say you're trying to buy a car, right? And you go to your dad and you're like, hey, Dad, can I borrow $10,000 to buy a car, right? And he's like, all right, I'll help you with your first car. You can pay me back. I'm going to charge you no interest on this. In other words, just pay me $500 a month until we pay the $10,000 off. We'll call it a day. However, right, if you went on the open market, right, and you got a $10,000 loan, you might pay 5% interest on that. So the difference between those two, right, I don't know, say you have a $10,000 loan, it's 5%, right? Hold on, let me pause this for a second. Sorry about that. $10,000 loan, 5%. Hey, that's going to be $500 of income to you. Now, there's like de minimis exceptions if the loan amount. Don't worry about like the exceptions. I'm just trying to get the main point across here. In other words, like if you look at both of these situations, the IRS doesn't let you kind of like behind the scenes tee things up, right? They're always going to compare the fair market value, right? What would happen on the open market with what actually happened. And to the extent there's a difference, right, that's going to be taxable income. Next one here, cancellation of debt income. The idea with this is, right, and again, just the general rule, say that you owe $10,000 to a credit card company. Okay, say they send you a letter in the mail that's like, hey, if you pay us $3,000, right, we will forgive $7,000, right? So just pay us $3,000 and then we'll call it a day, right? The idea with this is, and this like happens to people, you're going to get a 1099 in the mail for $7,000. So you may owe, on that $7,000, I don't know, let's just say $2,000 of income. So you may think, hey, I'm actually paying $3,000, I get rid of 10. Well, it's more like you're paying 5 by the time you consider the tax liability on that. And like, so maybe you're like, I win because I only paid 5 and I got rid of 10. You're ultimately going to lose because this is going to impact your credit score. All right, a few other items here. Municipal bond interest income. We talked about this in previous lectures. Not taxable. We're trying to support the state and local government, right? Hey, we have West Virginia. They're trying to fund a bridge they're going to issue bonds to do that. If you invest in that bond and receive interest, municipal bond interest income, it's not taxable. Likewise, gain on the sale of personal residence. The idea with this is they're trying to encourage people to buy and sell houses. The setup with this is if you sell a house, right, you're going to look back at the last 5 years. Did you live in it as your primary residence 2 of those last 5 years? If so, right, you can exclude the gain up to $250,000 if you're single and $500,000 if you're MFJ. So you need to know those thresholds. That's like one of the few numbers you have to memorize. So the idea with this is, and again, it's the gain. So if you sell it for $400,000 and you paid $100,000, right, you have a $300,000 gain. If you're single, right, 250 of that is excluded. Let's see here, 150 is included, right? So it doesn't exclude all of the gain, right? A lot of times people will be like, if you live in your house 2 years, you don't have to pay any tax on the sale. No, it's only up to that threshold amount. 250 if single, 500 if MFJ. All right, fringe benefits. The idea with this is, hey, your employer, they pay for part of your medical insurance. They pay, maybe some educational expenses for you. These kind of like sort of like fringe benefits, right? Like secondary benefits. Generally, right, most of them are going to be classified as qualified fringe benefits. And the idea with that is if they're qualified, then they qualify to be excluded. So I don't know, maybe your employer gives you a stapler, right? Hey, here's a stapler, use it, to staple things. Technically, right, that's, something you receive from your employer, but that's going to be like de minimis, right? That's going to be like de minimis qualified fringe benefit. All right, next one here, scholarships. The idea with these, they will be excluded to the extent they're used for tuition, fees, books, supplies, and other equipment. However, right, to the extent a scholarship is used for room and board, or if you provide services for the scholarship, there's some exceptions here, but generally, like if you're working and it's basically like a working agreement, that's going to be taxable. So maybe as an example, right, they give you 20 grand as a scholarship to come to a university. You use 12 of it for tuition and books, and you use 8 of it for room and board, right? So what you used for tuition fees and books, that's excluded from income. However, to the extent you use it for room and board, or just say you pocketed the money, right? Say they gave you 20, you used 12 for tuition, 6 for room and board, and then you kept 2 left over, you just kept it, that's taxable. All right, this thing, you can read this here. This essentially says certain investment accounts, so 529, Coverdale accounts, Series EE savings bonds. The idea with these is if you contribute to them, the growth upon that contribution is tax exempt if you use it for qualified education expenses. So I don't know, say you put 100 grand into one of these accounts, it grows to 130 grand. You then cash that account out and use it to pay for your son's medical school, right? The idea with this is that 30 grand of growth, you put 100 in, it grew to 130. You don't have to pay tax on that, assuming you meet certain criteria here. All right, gifts and inheritances, and then life insurance. So a gift is a lifetime transfer of property. It's basically a detached and disinterested transfer of property, no consideration, nothing expected in return, not taxable if you receive a gift. Likewise, an inheritance, that's basically a gift at death, not going to be taxable for federal income tax purposes. So, hey, grandma passes away, she leaves you her car, you don't got to pay federal income tax. There is a separate tax, right? There's a federal estate tax, and then some states have an estate tax. Usually the person who's like giving the gift is responsible for this, or giving the who dies, they have to pay the tax. But at least for the federal estate tax, that only applies if you're giving like millions and millions of dollars in gifts. All right, next one here, life insurance proceeds. General rule with this is if you are the beneficiary of a policy under life insurance proceeds, you don't have to pay tax. So I don't know, say you're a middle-aged male, and you're like, hey, I'm worried, like I have my family, if something happens, if I get sick, I want to provide for them after my death, right? So I'm going to buy a life insurance policy. Maybe I'll pay 20 grand for this thing. If I die, it will pay my kids $1 million. Right? So the kids, if, unfortunately, let's say this guy passes away, the kids get the money that's going to be tax exempt to them. Now, there are special rules, and don't worry about these. Like if you cash out a life insurance policy or if you sell it, right, then it might become taxable. But general rule is proceeds from a life insurance policy, not going to be taxable, excluded. All right, foreign earned income. The idea with this is you pay tax on your worldwide income. So, hey, you work in France, you make 10 grand, you got to pay the French government taxes on that. And in theory, you got to claim it on your US tax return. They want to avoid this, right? As a general rule, we want to avoid double taxation. They give you a couple of different mechanisms here, but the big one, because we're talking about exclusions, is this foreign earned income exclusion. And this basically says, hey, up to 120 grand of earned income overseas, you can exclude on your US tax return. So, hey, you made 10 grand over in France. That's great. You can exclude that. Here, you don't have to pay tax on it. That's well below 120 grand. And it's earned income, right? Foreign earned income. So they don't really have this as much for passive items. All right, next thing here, workers' comp, right? So, hey, you're hurt at work. You are then receive workers' compensation. Idea with this is it's going to be excluded from income. However, something similar, right? You're laid off and you're not working, you receive unemployment, that's taxable. It's included in income. So those ones are easy to mix up, keep it straight in your head. Workers' comp excluded, unemployment, right? During like whenever COVID happened, everybody was getting unemployment checks. That's taxable income, unemployment. All right, lawsuit, right? You sue somebody, you win money. Is that taxable? Well, it depends on the nature of the payment. In other words, if the settlement or the lawsuit proceeds are for a physical injury, hey, you break your arm, you get $100,000 in medical bills to fix your arm. The idea with that is if you sue and you win $100,000, you don't pay tax for it. It was from a physical injury. If, however, it's like for pure emotional distress, right? You hurt my feelings. I'm now like there's a lot of like psychological problems I'm having from this. That will be included in income. And then punitive damages, right, where we're trying to like punish the person and teach them a lesson. Don't do this again. That also will be taxable income. All right, last item or two here, healthcare reimbursement. So, hey, your health insurance company, you go to the doctor, you get an MRI, your insurance company, reimburses you for that or covers the cost. Not going to be taxable income. And then disability insurance. This is like workers' comp, but a little bit more restrictive rule. So it depends if the individual pays the premium or if the employer pays the premium. So you can look at that.